I'll give everybody a minute to get back. How's everybody doing, by the way? Everybody holding up okay? Comments, questions, anything? Today's a lot of theory, by the way. Today we're going over a ton of theory layers and less technical analysis, more about strategy, more about creating expectations, more about just starting to understand the foundation and the roots of how we can use strategy to make more money in the markets, because really that's the missing component for a lot of people. It's why I'm doing such a big focus on it lately, like with mental analysis too, right? Like there's mental analysis and strategy. Like I said earlier in this lesson, are two huge. Combine those two, and it's probably why most people who are seeing trades that aren't going their way are feeling that. After data points, polarity is the second most important part of butterfly effect. Have to rank the importance of them. I think all of butterfly effect is important. Butterfly effect even needs to be broken into two different courses. It's so important. Like what we learn in butterfly effect is kind of the opening to comparative analysis and not even really getting deeper into the heavy theorem in it. So I think, you know, if you were to talk about all 74 lessons in butterfly effect, you know, the reason we teach the reason I teach data points right at the start is because it's the foundation to everything. It's understanding that comparative analysis exists and it's real. To rank something after that, I don't even know if I'd rank data points the most important. I would rank, like I've said I would in the past, and I guess I would, but it would be different type of most important. I would say it's the most, it would, if there would be a bunch of awards. What's the best lesson? What is the lesson that will garnish you the most money? What's the most important lesson? What is the lesson you have to watch twice? Like I think there's a lot of boxes you could fit a lot of these lessons into. To say what's the most important would almost, and without any other consideration to like what are some of the other major things. What is the turning point lesson for most people? Where's the X factor in butterfly effect? There's so many. There's, okay, yeah, data points most important lesson, because if you miss it, you wouldn't understand the entire course. But that doesn't mean it's the best. I don't think there's the best. You know what I mean? Yeah, I don't think there would be a best lesson. The second most important. Oh man, that's almost like a loaded, like I said, that's kind of that's loaded. That's too much of a loaded question, because it implies that there's other things that aren't highly valuable in different ways. I would say that can't be answered. I would call it the data points the most important lesson, because without data points, you won't understand any of it. I would also call what we're doing now, active and passive contracts. I would call that the most overlooked lesson, because the value of active and passive contracts really becomes the opening segment, or the opening, what would you call that at the beginning of the book? Not the introduction, but they have something before that. Anyways, it would be the introduction to understanding polarity. Polarity is probably the most valuable point of butterfly effect. And that's not true, because chart architecture is, how do you even define the most valuable point? I would say the most overlooked lesson is probably active and passive contracts, because there's a deeper understanding there that I simply wouldn't go into just making a video in layman's terms. There's a much deeper understanding there that presets the entirety of everything to come after it. Trigger points, ranges. So the most overlooked lesson is absolutely active and passive contracts. I would put that title there. The points one day at a time, ranges, polarity. Yeah, one day at a time is important, but one day at a time kind of ends a chapter. It's like, okay, we learned levels. Let's do this stuff one day at a time. It's kind of the end of a chapter, right? Like it's really important. People see one day at a time because it's very connectable to people. People learn this material, and it's very hard to learn. Which like I said earlier, I'm going to make TikTok videos on that, and IG videos on how you learn better in the upcoming week. But like one day at a time kind of ties everything into this simple formula, and people like simple. People like something they can follow. So as a teacher, somebody who has to find the best, most optimized way to show people how to learn. Preface. Yeah, there you go. Thanks, Kathleen. One day at a time is a great lesson, and most people see it as the best lesson in all of butterfly effect, because one day at a time shows them, oh, slow down. This is easy. There is a system after all. This is how we can do it. Like it very much connects with people on that layer where it can be application, but application applied improperly is still a shitty trader. You know what I mean? So application used at a percentage of what it's supposed to be used at, it still equates to like a shit trader. Not to say people at one day at a time are shit traders, just to put into perspective why one day at a time, it's a great lesson, but it's more for people and less for learning that lesson. It becomes the opening arguments or the preface into understanding strategy. And then active and passive contracts allow you to understand polarity, which really should be the starting point of any ladder. When ladders create ranges, or a range is created prior to a ladder, and a ladder can test by deep diving a whole level to create another ladder point, which is respecting a range, which is creating a trend. And all that is created off of active and passive contracts. So by understanding active and passive contracts, you understand the very first step and all of the theory thereafter. So active and passive contracts is heavy in theory on purpose for this reason. But if you understand it, you can then start to understand and justify, hey, ladder points, these make sense. And people say, well, how did you see 29.2? Well, it's easy technically to see 29.2, but to make that decision of why it can move up when I said, 29.244 or whatever, and hit 29.242, it's $2 off the target before it does this run up to 60K. Like, so there's a reason, a deeper theory that allows me to understand it. So active and passive contracts, definitely the most overlooked, because it's kind of the opening arguments, the preface, or the statement that by understanding it at a deeper level, you can make more sense out of every lesson going forward. So it's kind of important in that way to go through it a second time with a deeper understanding, because it's like a level up to all the other theory. When you understand it, it levels up all your other theories. You may understand trigger points, but if you understand active and passive contracts, trigger points become 10 times more valuable. You may get ladder points and ranges by understanding active and passive contracts and the formula that's used. Those become 10 times more powerful and valuable as well. You see, so active and passive contracts, while it may be heavy in theory, really is the X factor for the other things. But by itself, it's useless. But as it should be, because it's a form, like I showed you guys earlier, I see it as a formula and the way that it works, and then you can understand bigger parts of the market. I feel like you are still getting better from teaching this stuff. It seems like these aspects are so fundamental for you. I mean, I've done this a long time, so I guess I just always tell people it's the mark of how you see if somebody really knows what they're talking about, how deep they can go into the theory. Because I've seen people try to teach my stuff before, and it's always kind of muddled. And I mean, it's just like with anything in life. You truly understand if somebody knows deepest roots of something, the way that they can describe it to others. Because in order to be able to describe it, you have to understand it at a very intimate level, something that you've been working with either a lifetime or something that you have tens of thousands of hours in, or I don't know if I'm still learning stuff. I'm learning how to become a better teacher all the time. Recently, I've learned that there's certain cues that I have to pick up on my students in order to direct the content. And before, I just had a plan. I just had a plan to direct content. Now, I look at my students, I analyze them, and it's much more of a dynamic system that I create. Before, it was very static. It was, okay, release this course, release that course, release this course. It was a very specific plan that I had. Right now, it's more of a dynamic understanding. So I have a plan of things I want to release, and I dynamicize the release dates by understanding what my students need the most. So I guess that's a way I'm learning how to become a better teacher right now, is finding the points where people need help. And then I already have the plan in place to release the material anyways. It's like, okay, which order does this come out in? And that's where I'm getting better. I feel like I've really done a good job of that recently in this past 3 months of looking at the mentee students and taking an overall look, introducing mental analysis, the Mind Training Center, the way in which I'm releasing material. Everything seems to be clicking together in such an organic, perfect way for people, which is good. I'm going to catch up on chat from earlier. A lot of sense. A few months ago, I listened to a big market mover from Vancouver, how they use big liquidity to move markets the way they want it to fill their many positions. They can't with only one. That's why you see ladders, I guess. Yeah, absolutely, for sure. So you can't always get your positions filled. It depends on the size. It's hard. Hedge mode trading. Yeah, I think hedge mode is great. It's the highest level for sure, but it's great. They're very professional level. Okay, what else did I miss? You guys are talking about the ad. Nice. No problem. I get it. I think I get it. Thanks. Yeah, we got that. The order flow of your lessons is beyond excellent. Yeah, I've always had that in mind, like which way to teach people help, because it's very tough, because I have my demised formula in my head. This big picture, like inside my brain, is like this, like a scene out of a movie. It's like 50 chalkboards all on this big 80-foot wall, and they're all like formula here, formula there. I've got all these different pieces of the charts and pieces of information compartmentalized so I can make the most sense out of them quickly. It's the way my mind works. Very much like photographic memory, but combining that with I always screw this word up. Compartmentalization. Part happens to everybody I know. You try to say compartmentalization without making it sound stupid. Compartmental. Compartmental. I don't know. Anyways, doesn't matter. I always screw this word up. Like all these chalkboards compartmentalized in my mind. And yeah, it's like picking which chalkboard comes next is important. So the order flow is definitely something I focused on. Yeah, you guys are saying it out loud now. You guys are doing the same thing. Compartmentalization. There you go, dude. IC is like 500 IQ for sure. Huge. Yeah, yes, it's a tough one. I mean, this takes all the turning points to create the. Yeah, the data, like it's so important. This lesson is it's so heavy in theory, but it's what creates like the first brick. It's the mortar before you lay the foundation, right? Like it's literally the first brick in rebar where you build a house, or you create your concrete form. You have to lay like a footing of concrete with rebar in it. That's what this is. It's like the concrete footing. Let's see. I've always been lazy to learn. Your material turns my mind on another level. I rarely experience beyond patience. That's so awesome. Thank you so much, man. That's such a compliment. I'm going to be talking about how we learn better next week in my TikTok release. It just, guys, really pay attention to that, because I'm going to say it here as for you guys first. And I talked about a bit about this before. Cognitive strain is the way our mind works best. So this is why universities work so well to teach us, because cognitive strain is when our mind learns. System 2, which is our logical mind, is very, very lazy. It doesn't activate unless it has to. System 1 drives everything that we have in life. Maybe I'll talk a bit about this today on stream instead of wasting our time. Yeah, I'll talk a bit about this on stream today. But anyways, I'll give you guys the good stuff, which is we learn under cognitive strain. So when our mind is pushed to its absolute limit and it's burning out, that's when the brain learns, because it forces itself intake the knowledge so it can get through the moment. So it mobilizes under cognitive strain, and it mobilizes under stupidity. So worst font in history. You'll never forget this image, because there's something that happens to the mind. You'll also never forget this image. What's the worst font you've ever seen? Bleeding Cowboys. That will now forever be burned into your brain. Bleeding Cowboys. Because when something is so grotesquely bad, it forces system 2 to mobilize. When it becomes so confused as to why system 1, which is your emotional layer, is having a connection with this, system 1 creates confusion because it's just so ugly that system 2, it forces it to mobilize. It forces your logical layer to activate. Overused Bleeding Cowboy font. Tattoo. Oh boy, going down the rabbit hole. So system 2, which is your logical layer, mobilizes under cognitive strain and under extreme stupidity. It's why so much YouTube content has so many clicks, because the only time people learn is when the material is horrible. The shittier the material, and they've done studies on this, the shittier the material and the uglier the fonts and the worse the colors are, the better people learn, because it forces system 2 to activate by rejecting the confusion of system 1. This is the way the psychological mind works. Shittier the material, the better people learn. The more you strain the mind, the better people learn. So those are the two pretexts as to where the mind operates at its best and intakes information so good. It's why so many people have to go through butterfly effect so many times, because one time through, it's not enough. They just kind of whatever. Until you have cognitive strain, system 2 doesn't mobilize. So this is why university works so well, because it forces you into these ridiculous routines where your mind is so drained that it forces the brain to learn. It's called cognitive strain. It's called learning under extremes. And when system 1 has this feeling of, ooh, disgust, it's why people learn, because it forces system 2, the logical layer, to mobilize, to make sense of a confusing moment. So it forces your mind to learn. You go on YouTube, look at the cringiest effing thumbnails that give you the most gross reactions, they'll have the highest views, because it forces the mind to learn. Imagine seeing a thumbnail. Imagine going and searching for something, whatever. Imagine going and searching for something. Oops, I pressed play. Imagine going for and searching for something on and seeing this ridiculous thumbnail that's so ugly. You're like, oh my God, this is so crap. I need to see what this is about. Isn't that like the first reaction you guys get? You need to learn what it's about. Why is this so ugly? It's like watching you know that famous saying, like, oh, train is crashing and I can't stop watching. It's so bad, it forces the mind to watch. It's like, it's so, you could make like hyper shitty thumbnails and you'd get more views. So it's like a mind trick that you can do, but it's not really a good one because it's like you're basically selling your soul to take advantage of the mind. And if you ever wonder why you look at something that's so bad, it's like watching a train crash, that famous saying, it's why it happens. The shittier the material, the better you learn. Because it forces the mind to question. It forces the mind to say, God, this is so disgusting. I need to see what's going on. Haven't you guys ever noticed that about like TikTok? You'll watch the ones that piss you off the most, the longest. You guys ever like scroll down TikToks and like you're so pissed off, it allures you in? Rick Astley, I don't even know who that is, but I'll take your word for it. I wonder we humans are dumb. Reminds me of pressure which builds up from procrastination. How can be motivation, but the goal is the things. The goal is to do the things one needs to. Oh yeah, Rick Astley, Rick rolled, right? That's why the mind does that. That's why we watch things. That's why the saying, "I want to watch the train crash," or whatever it is. Like you just want to see the world burn. Just want to see the world crash. The more emotion that's involved, the more disgust that's there, the more it forces the mind to learn. So the shittier the material, the more retention it has. You can see it in thumbnails. You can see it on social media. You can see it on Twitter. The most stupid thumbnail makes your brain like question what's happening, and then you click it to justify that injustice, to justify that disgust. It's again, it's just human psychology. It's the way the mind works. So cognitive strain, shit material. That's when your brain works. That's when it learns. So if you're not straining yourself on this material, you won't learn it. If you go watch it once and kind of that's why you have to go multiple passes on my courses, because they're too dense in material and you have to go through cognitive strain in order to intake it properly, because there's no sellout content. If I put a bunch of shit thumbnails and weird pictures, it would force you to pay attention because your mind rejects the emotion of disgust and frustration. It rejects that, so it forces the logical mind to mobilize. Okay, let's continue on. It's a fun fact though for you guys. That's how you learn.
This is something where you have to understand the difference of what makes something move between active positions opening and current contracts closing, because that will help you see where your targets are. To understand that is to also go like this and say, if I was, now we're going to delete some of these levels as well. Let's go with this one. We don't need this one anymore. We don't need this one anymore. We certainly don't need this one. Well, this one's not bad. It's a hold level. It's fine. If I was in this trade and I had entered this hold level here, and I would see this as target, I would simply be entering here, exiting here, and possibly opening up a new short if I had the time, and I would be targeting my level below, which is the exact move that it went to, the hold level down here, the part of its range that's represented, right? So, you know, the part of its range that it goes after. You quickly see where these contracts, the difference between active contracts, which are new positions opening, because you should have new positions opening here and here, as well as you should have in that same moment, not only active contracts opening, but you have contracts closing at the same time. So that's what creates these things and their ability to hold, is where the true target is. You'll have a confluence of not only active but closing trades. So you'll have new active positions opening on those levels, like we buy hold levels because those are active positions. We also target hold levels to close our positions because those are closing positions. And this greatly helps with defining targets, understanding where we should be buying and selling, because this is the confluence that's created that stops these things from moving. Active and passive, if you want to call them passive. So active contracts opening and passive contracts that are already open that need to close, or closing contracts. So active, I'll write that on the screen because it sounds confusing. So you have active, not like this. You have active contracts happening and passive / closing, because passive and closing are the same thing. It's a passive contract because it's open until it's closed, or it's a closing contract, right? So you have both of these things happening in this moment, both of these things happening in this moment. This is what creates levels to hold. Okay. So this creates the levels to hold. Oh boy, what am I doing? Let's try this again. Round 2. Active contracts opening, right? No, not that one. Not that one. This one, copy, paste. Good. And passive and closing contracts here, right? So passive contracts are the contracts that lose money unless target is hit. Passive and closing contracts are what make up a move, right? This is what makes this move happen. Like as I'm scrubbing this passive and closing text here, this is the range that makes this possible as to where active, right? But theoretically, passive and closing contracts are happening everywhere. Like technically, if you had somebody who was like a master scalper, so you have this level right here, which is the top of the range on this, they could open up an active position there, open another active position here while passive and closing this position up here. So you have a duality of actions that happen, which actually compounds the moves and makes them. That's right? How the big players work, right?
They talked about today,
active and passive contracts on every single level. And those active and passive contracts are closed, appropriated to the actions that are happening in the market, or the architecture that's developed in the market is the decision of passive closing contracts. So actually, the big players never have non-passive trades. They always have passive trades open, because this passive trade here, or I should say this trade that becomes active in my drawing tool, this trade that becomes active here is a passive trade. It closes on this level, also opening up a new active on this level at the same time. So it's a double injection of volume. And then those two same things happen up here, active and passive. So technically, biggest players, or the ones who really know what they're doing, always have passive contracts open 24/7. Never ends, because the levels they're selling, they're also rebuying. So they are literally selling, opening, selling, opening, selling, opening, selling, opening. So there's always a contract open. So if you're really good, you'll always have a contract open. So that's something to strive towards, is to constantly have. That's a tough thing to do. That's no easy feat. This is, you're talking about chart mastery that is nailing every level 100%. But really, the point being is that if this is your target, you should be in a trade until it hits. And if you think this is what's going to pull it back, you should also be shorting that level. So not only should you be closing a contract, but you should also be opening a new contract there. And then this level down here would be your target from up here, and you should actively be closing and opening a new contract there. The problem becomes when you're wrong, because you quickly wash away all of your profits. So whatever you made here, if you made 3% here, and you relong at 100x here, if you're wrong, you still make 3%, but you instantly forfeit 100% of it because you were wrong and it liquidated your move, right? So there's a punishment in being wrong, but also an invaluable reward for being right by marking these levels properly. So active and passive contracts are the way in which we can decipher what's happening in the moment. After that, we can simply go back to this, and we get rid of all this. We simply go to our replayer tool here, go to 1-minute charts, and let this thing move, and you'll, for yourselves, see where the contracts are closing. Like, all the moves holding, we're starting to close contracts. It's stabilizing even more. Active trades are now stabilizing the move. So when do the passive trades close out and say, oh, this is actually holding, we need to exit our trades, right? There's a moment there that happens, and it's right there.
Oh, sorry, I had my mic muted. I muted it because I coughed. I forgot. Okay, so what I was saying is that just a quick note on this, and what Jacek had mentioned earlier about not understanding where to close a trade. Say you open a short here, and it's gonna kind of be a repeat of what I said earlier, but again, still important to highlight. You open a short here because it's a level. You create a set of sub strategies of what can happen, whether you're going to take your target here, whether you're going to use this hold level as your guide to stop gain in the trade. Doesn't mean you need to take your trade target here. You can. The decision becomes yours. I think that the clear outcome here becomes like this. Like, you could take this as your target, but I want to see if this is going to break down to a lower level. So instead of taking that 40 or 50% that Jacek talks about, oh, I took 40%. I'm not too sure if this was correct or incorrect. You could simply use a trend as your trigger. So this level gets hit, and holds. Trend is like this. So you have trend breaks, and then you have like this, maybe looks like a 5-minute hold here, or like a 3-minute hold level. You get out of the trade on this candle here, because this candle here is clearly going to be the breakout moment. So then that just becomes understanding where your passive contract should close, because you've opened an active short here. It's hit the level, right? The level is something that you don't want to see, like, oh, I want to take 140%, because it usually goes down to this range. So you don't have to exit on this level, but what you do have to do is understand where your passive contracts need to close, right? You guys have sound. Yeah, you guys have sound. I can see it on my bar now. I just had my mic muted. So the next thing becomes, okay, let's draw a trend. If we break trend and the level, we have two criterias here. So we would have a trend like this, and if trend breaks, we also need to break the level. And the second that the level breaks is when you get out of the trade. That would be the way that you minimize the amount of money you leave on the table if you're waiting for it to go down. So identifying that you're in a passive contract and what those possible trigger points could be that release you from your passive contract is just how you do that. It's the way that you can constantly stay in a move, and both your trigger points are released, the hold level and the trend that's created. So that just to go over J6 comment again, that's the way you would do that, which we'll learn more about.
New shorts open, which just makes the problem worse for those shorts, right? The new shorts that open just make it even worse, right? The second go at this thing, it's like even worse, because now they're going to fuel this move. As soon as it goes over this level, any new active positions that open will quickly close.
Because like the reality is, if you have an active short open here, which you should, that's why we have the level marked. I believe yellow is a 4 hour, so this looks like the 4-hour trade. You have an active short open here. Doesn't mean you need to open an active long here.
And then you have new active trades executing in here.
You'd have an active short, and what would you use as your guide?
You have both.
You're already seeing that a range is developing, so you could use this like trend like this, right? You could use that trend like that.
Both events happening at once.
You haven't entered your trade yet. It's as simple as that. There's your trade.
This is where both events,
right? There's your trade. You've got that level from down here, creating this trend like this. Like it looks like a trend like that, or if not, you could just attach these two as your trigger point. If this continues to hold the move, you know that your passive has to close,
which is enough to make this move go the other direction. Any chart you look at, you can see
there it is. It's still holding, right? It's still holding. You actually wouldn't be out of this trade yet. Now you'd have to adapt.
There must be
a little hard to do on the fly, but that's fine.
Same thing.
Because this to here looks like it wouldn't have had a hard close there. It would have just been here, and we'd either stop gained right here, or you would still be in the trade. Because you actually didn't hard close. And it's kind of hard to tell without the trends on our chart.
Are going to sit there and say, the second we get under this, we're going to start closing contracts. So the second this open contracts. Yeah, they are smart. They close a contract. Open contracts, open longs, open longs, open longs, open longs. Also opening longs up here because these people are thinking it's going to move up. All these open longs. Second it goes under this price, you have an influx of those closing. So you have a quick little pullback. And then you have new longs.
Now that's that polarity in the move, right? That's how you identify that. That's a polarity where you get that happening, and then you think you just end up breaking trend here. I think you end up, looks like what breaks trend right here. Like this little line right here looks like it's like a trend from down here.
This move holds below polarity. What started this move. All of a sudden, these guys start to exit. And then everybody's exiting because they're getting liquidated. So then, burp, and it goes right down. You can see this on the charts. Like they communicate it to you. You can read what people are doing through watching these levels and how they visually are developing in the moment, right? Like the visual development of these levels, it's showing to you. It's very, very straightforward. And you can see where a volume is about to come in if you understand the way in which active and passive contracts work. And then, so the same thing down here, right? You have people who are in these shorts up here, right? Not only are contracts closing, but people see this 4 hour above, so they're opening the yellow lines. So it's just compounding.
4 to 4 here.
Not only is the move already broken, because the people who are long, the people who long this actually broke their own move. As silly as that sounds, because nothing had to happen. Just a lack of longs coming in means that all of these longs that came in on this level, a lack of longs to pull this move up, right? A lack of longs actually means these longs will all start to exit, which is what breaks this move down. And then active positions open here, and then.
So you guys are now seeing how you're understanding that's how the polarity gets created when active longs close active positions. When A cancels A, polarity is true. That's what you're seeing here. Like that formula I gave you guys earlier of active longs, A A. When passive is false, A cancels A. So active longs turn into active shorts because P is false, which is passive, and it creates polarity in a move. So that's exactly what we
It
described
happens like
earlier.
that
That's
because
that
people start
same
to panic
formula
and
you're
leave
seeing here.
as fast as they got in. Then they just get out faster than they can even think. That's what happens. And then you have stuff like this. You have stuff like this where you fall off a cliff. So the important thing to know here is imagine how many long positions opened right here and how many of them will close once you start to breach this level. Because in one way, this looks like it's holding. It does look like it's holding level. But in the other sense,
like a ladder.
imagine how many contracts are going to close once you lose
But
this
upon
level. Once
passive
that level
failure,
collapses,
ladder failure
imagine
equals
like,
active
what is the
shorts
timestamp
canceling
here?
the active longs, and active longs participating in active shorts.
6:29. So 70 minutes or whatever. We'll just call it an hour. An hour of longs opening, and the only people who took the shorts are like here and here. And these shorts came in from like way the heck back there. All of this new stuff here that opened. Imagine how hard this thing is going to get hit once this loses this moment here. An hour of longs. It only takes 1 minute of shorts to kill a move. An hour of longs. Geez, imagine what that could do to a move that's not moving up.
That's the key wording right there. Like, I have to break this down into layman's terms for people and say, okay, an hour of longs, but really I say one key thing there.
Imagine how hard this thing is going to get hit once this loses this moment here. An hour of longs. It only takes 1 minute of shorts to kill a move. An hour of longs. Geez, imagine what that could do to a move that's not moving up.
Imagine what can happen if something's not moving up. So passive contracts. So that's often you guys will hear me say, it has to continue moving up at this point. This is why. This is why I say that. I've said it on stream before. I've said it in lessons. It has to continue moving up if it doesn't want to dump. It's kind of weird, kind of counterintuitive. Like, isn't it laddering? No. The onus is for it to move up because the active contracts will start closing against themselves. And then that creates a passive failure. So this is why I say that sometimes when I say it. This thing has to move up now. It's not about it laddering. There's a point where a ladder breaks itself by not moving up. So something may look like it's laddering in one time frame, or on a chart, it may look like it's indeed laddering up, but it actually has to continue to move up so that that ladder doesn't break. There's kind of like a deeper theory with active and passive contracts and how they work to break ladders, like the breaking of a ladder. Like, oh, it's laddering up. Yeah, well, the breaking of a ladder happens when something refuses to move up, because it's all about passive and active contracts. So that's why sometimes you guys hear me say, oh, it has to move up.
We assess these
things
to
continue
visually sometimes.
There's a reason why
when it
has
comes
to continue
to
going.
active and passive positions, because we can see it happening on the charts, but really that doesn't aid us in our decisions to make where we open these contracts. Rather, what it does is it allows us to understand when the move is collapsing. So it protects us from making bad entries, and also verifying what
something isn't going up anymore. It's not about it laddering. The moment it loses that momentum, it becomes like the trigger point for passive contracts to close their actives.
think is about to happen. So it's really interesting to watch. Even if we go right now in the moment, let's just see where we are right now.
Layman's versus actuality.
Exit the replayer tool. And then I would imagine there's a bulk of shorts happening right here. Right here. I'd imagine there's a bulk of shorts.
But do you guys remember a few weeks ago when I said whatever range breaks you can also hold you down? That's what you're seeing here. This is the range that breaks you. It's also what can hold down the next move. So I don't know if you guys remember when I said that, but when I first had this level marked, it was back here. What creates your range is also the polarity point backside for the next range. It's just what you're seeing here.
Anything
it's just kind of interesting to see these things always just kind of work together in harmony. It's just
so all of that is going to close once we get above that. So then you just have your trend players, right? Here's one, the first round of it right here. Right, there's a first round of it.
Thus, you now have cycles, polarity points that create cycles, and how cycles can get created on a deeper level.
You've got this one right here.
Start to understand active and passive contracts and what breaks ranges. You then have the creation of cycles, which is really neat because now you're talking about such a basic formula of cycles.
That got in here,
accumulation and distribution cycles.
The longs that got in here,
back to active and passive contracts.
Laddered the range to here.
The beginning.
Then you've got
beginning of the end. You know, like the theory, the formula that creates it all. Right? Like really neat. And it's really cool.
Long right here. Imagine
really beautiful cohesion of
shorts. This whole entire piece is basically going to short this thing.
Find these little nuggets that I drop here and there, and then all of a sudden you see them a second, third time, and it's like, oh,
you can already see it.
Interesting.
Like if we don't quickly get over top of this right here, like if we don't get over something like this, and again, these are just little local trends that are just kind of, we're just drawing them for this example. If we don't get over top of this, shorts will start to close. So when you cross this trend here, guess what's going to happen, right? If you can't, if you don't have, like, this is another moment here. It's like this.
Do shorts close? When do longs close? That's going to be the first thing you guys ask yourself after this lesson. You're going to go look at the charts and you're going to say,
don't open here,
God, I don't know. When does the short close? When do the longs close?
So if new longs
really interesting because it works on both sides,
don't
right?
close,
This becomes a really interesting debate you'll have with yourselves over the coming week or two.
Because this is going to be best entry, right?
You'll start looking at these charts and you'll be like, oh, there must be a lot of passive longs from back here. When are they going to close? And you'll start asking yourself. And then you're just going to say, oh, I wonder how many passive longs closed here. Ooh. Look at the chart right now and you'll say, oh, I wonder how many passive longs close there. And then you'll sit here and you'll say, oh, okay, so some passive longs just closed there to reactivate here to passive long there. I wonder how many. I wonder how many passive shorts are going to close to create new longs. And then when the new longs are coming in, I wonder how many passive longs. It becomes this constant battle back and forth that you'll ask yourself for the rest of your trading career is where, oh, I wonder where the passives and the actives are going. Like you'll start putting your brain into other, like you put your brain on a plateau and say, oh, where's their brain? What is it doing here? What are they doing, right? Like you'll start saying, what are they doing? And they become a character in your own story. They become the enemy, the villain of your own justifications. And wonder where they're closing. It becomes really interesting because then you can really start to understand the charts. And now you're talking about, human psychology and trying to dissect what happens at these points of polarity psychology wise. So it becomes really interesting because then you go down this further trail of the mind and how the decisions they make, but then it's also tied together with a formula. But human beings are still human beings, so they have influencers, right? But the best of them don't because they know this stuff. But it's really cool because it really, oh yeah, Seabass said exactly what I was about to say. It really allows you to see what's happening on the charts, and he said it really allows you to see what's happening behind the scenes that creates the charts. Yeah, it's really interesting. It becomes its own metagame in itself, and the psychology behind trading, which is created off data points, and the data points are create new psychology points. So the data points actually come first, and the data points are derived off of a formula, and the formula can exist under certain pretenses of trues and falses that go down a logic tree, which create psychology points, which create a psychology map. So data points create a psychological map of decisions. Then it goes into another huge branching of decisions between psychology points. So now you guys are going to go in these charts over the next 2 weeks and you're going to start saying, I wonder where passives are closing. Why would they close passives there? So now you're trying to understand their mind. So now you're down the psychology hole, but you're using data points to make those assertions. You're using the data points to figure those things out. And you're saying, oh, well, interesting. So what happened here? Oh, I know what happened here. All these longs from here close there. So where are these longs going to close? Oh, I suppose I need to find their range. Okay, so where's polarity? If this is the actual point, polarity can exist back on its point, which means it kind of has to hit this hold level. It has to break below this hold level. So actually, when you lose this hold level, that's the polarity of this range. So actually, you should go back and test the bottom parts of its range if it can't hold this. And you're going to say, oh, well, then that's fine. So that's where this polarity is created. What about the polarity up top? What about here? What passive contracts close there? Oh, these ones close there. Okay, interesting. So what could be the event where the next set of passive contracts here that didn't have enough time to get out? Where could they get out? So then you're going to say, oh, well, where do the longs exit? Well, where do the shorts exit? So it's really interesting. It's really interesting because it comes this bigger justification and understanding the way the mind works and optimizing and the strategy behind the markets, and as they say, from a psychology standpoint and the way it works. It's really kind of cool. It's like this really neat thing. Although the psychological decisions, they don't really make a difference, they help you understand polarity, because polarity is the first justifier, and the psychological map that comes thereafter, the decision layers that humans make, is seen on the charts. Like you can read people's minds on the charts almost. Like you can read the charts and you can see into the mind of other people and how they made those decisions. So it allows you to have a better insight.
Just kind of watch this thing for a minute, see what it does, and you'll see where contracts exit. You'll see
closing your position from 29. Yeah, I think a lot of people are going to,
because you'll have all
trigger
of these
points.
Contracts exit.
I think you can create trigger points here, and trigger points are trends. So you can create some of these, like you could go like that, and then you could go this one right here, because that would be the next one right to there. And then you could say, this one to here. And now you're starting to talk about like it's something I haven't named, or something I know the theory and I know the formula. I just don't have a name for it. We're just going to call it recycling for now. It just recycles itself down into a moment where it breaks trend, and then you have different moments of recycling that happen. So it just ends up being this, you know, the more that these exterior layers compound interior wise, it's almost like angle of an airplane. Think of it like that. Like the harder it goes nose down, the harder it's crashing becomes, the more, the final moments before you can pull that joystick back, or pull the what do they call that? The bow of the plane, or the not the roll, not the bow, the dow of the plane. I think that's what it's called. Like before a plane crashes, you can go see nose dive down as far as you can, and then you can create that polarity based on other factors, which that's more butterfly effect 2 stuff, but and finding tops and bottoms. But then that's pretty cool. The yow, why? That's what it is. The yow, right? Am I right? Pilots in here? Do we have any pilots? I know we have pilots in the community. The yow of the plane. Am I right? I know it has a term. Is the yow? Yow. Let's Google this. Airplane yow. Pretty sure it's yow. That's the pitch, right? God, I'm probably so off. Let's move on.
Exit here. Anybody who's opening longs because they think this is breaking.
Yes, the yaw of the plane, the up and yes, the vertical motion, not the horizontal pitch, not the say horizontal. Gotta continue. Horizontal pitch, not the vertical.
If it breaks down, if it breaks up, you're going to see these people exiting. So people who have shorted this level, so this a couple hundred Bitcoin that comes in here, will exit the trade here. It's going to go through here, and this is who's exiting that trade, right? Because this is like kind of the first moment before a breakout. See what happens here over the next minute or so. A hard close. We've got contracts exiting. People are sitting there, finger on the trigger, waiting and saying, okay, I entered how much X amount of Bitcoin here. I better get the hell out of this move. So that's probably what you're seeing right now, is contracts closing. This is not like active positions opening. This is contracts closing. This thing doesn't have enough contracts closed, you'll have a new round of active contracts come in to short this thing down. So that's where you'll see a big dump happen.
All of a sudden a hard close makes sense.
If there's not enough active and passive contracts. Or if there's not enough, sorry.
All of a sudden we have if justification for the deep dive. The hard close and why it works, because it can't confirm all time frames.
There's going to be active shorts opening, and vice versa. If there's not enough active longs
horizontal,
shorts will come. Or sorry,
I know, dude. I'm sorry.
That's a tongue twister. Okay. If there's not enough shorts, longs will close. If there's not enough longs, shorts will close. There we go. Got it. Nailed it. Second try.
I've been doing it in the video here. See?
You can just watch this for a minute, see how it unfolds. So I would expect if this hard closes here, you're going to see a large amount of shorts close. But if those shorts can't close, you're going to have active shorts coming in, more active shorts. These decisions are usually made in the last, encompassing seconds, because they're, you've got people sitting here waiting to close these shorts in case this thing moves up to take their profits. So they're going to wait till like 55, 56, 57 before the 60-second mark. And then when that 60-second mark comes in, the first candle that opens, you're going to see like a couple seconds pass, burp, right? Because that's what happens.
Another reason why this happens, without getting into it too much in this video, when I first made this, the other reason why this happens is because people who are hedging imagine you're hedging a position. You want to hedge a position that can confirm more information. So if you're given the option, now you're talking about like a logical layer of like a thinking layer, a theoretical layer, something that can create data. So what could you do? What action could you take to create data on the chart? So if you were to hedge this, when would you wait? Well, you would wait for the last second or two, because your hedge has the biggest spread between hard closing information X, a few seconds before, a few seconds after. This is where you can really also understand when you understand the psychological layer of traders and active and passive contracts, you can say, okay, there's a 4-hour that's about to open if X happens, or there's a 4-hour opened that just happened because of Y. So then you take that and you say, oh, I'm going to hedge a trade. What would be the most logical way to do this? Well, the most logical way to hedge a trade, if you're closing a passive contract, which now you need to understand if it's passive or active to understand where points of polarity happen, would be to create data on the charts. So if you were to create data on the charts, you would do it in the last few seconds or the first few seconds, as those would be the dictators of new information or old information about to create new information. So now active and passive contracts goes even a layer deeper as to when do active and passive contracts close. So now you interject the variable of time with active and passive contracts. Now there's a whole nother umbrella of decisions that need to be made around the integer of time, right? So that's important to know as well. Not that I expect people in here to be like, oh, passive contract closing in exactly 4 seconds if it does this X, but this can also lead to understanding things and the justification of when it happens. So I almost have to be a super calculator to understand this stuff, but it's a part of the variable of decisions that get made is what can time, what is the effect of time? Is why I talk about horizontal and vertical axes in 2 different measurements in future of trading, because a measurement of time has its own valuable, as its own integer that can be combined with things like hard closing, that can be combined with things like passive contracts. Because a passive and active contract, the decision point, right? It's, oh, I have a contract, I need to make a decision. The decision can have more impact if I combine it with the effect of time. And then time has its own tree map, right? So what the hell? Am I talking right now?
Isn't actually moving up unless it's going to happen in the last few seconds. But again, that's why we don't make these decisions until certain times, right?
Like I said, the most
We always wait for
undervalued lesson in the entire butterfly effect is active and passive contracts,
whim.
because it
There's a
represents
reason
something
why we
that's
do
not
everything in these
discussed as
things.
much, or it's discussed without knowing. And again, I just have to always remember that layman's terms of the people who are watching at home versus how I see things and the deeper layers. Like this is exactly where you would need to learn this stuff, is in a mentorship session, because it's, you have to go through this stuff, or at least we need to talk about it
Enough
to
longs
understand
don't close,
these
hammer down.
different effects of the charts. Your brain hurts, not good. It means you're learning.
Shorts that close.
Cognitive strain.
Saying the opposite. If there's not enough shorts that close here, tons of active shorts will open.
Probably such a huge missing component for so many people in here this lesson.
And of course, we always need to look at the higher time frame. See, that's contracts closing because it hard closed. Because everybody who entered here wants to lock in profit. This moment right here, it's like if entered here wants to lock here, tons.
The effective time, 2:59, 3-minute candle hard closes, 3-minute level tested, 3-minute level laddering, and create possibly, and what's the timestamp? Where's the overall time? Shit, I don't see it. I wanted to see if there's a coordination between also a 5 and a 15-minute. Imagine passive contracts. Imagine you're in a trade short from here. You know all that you know now that we talked about today. You shorted this level. Perfect. You got ideal entry. You marked the right level. You picked it. You entered your trade. Good. You've done your job. What becomes a trigger point? Where does your information have the most value? 3-minute chart is to what it looks like, the 3-minute hold level holding it here, the reverse level holding it here, right? Or possibly backside. I can't tell without actually having the chart in front of me, but I'm assuming it's backside here. I'm assuming it's reverse, backside, hard close this 3-minute level. So this 3-minute level is now hard closed here, and this hard closes the trend, the effect of time with passive contracts. If you were therefore in a passive contract, doesn't this look like the perfect moment to exit the trade before it launches? Well, you can't, you no longer can reject hard close your contract below. So this just becomes a very simple trigger point on a passive contract where you should just get out of your trade.
Of active
8,
shorts
3, 2,
open.
1, 0, contract being filled. Probably whoever's trying to get out of the trade being filled. Panic selling, you see it in that little wick spike there, right? Break over. This is the final ladder point. Is it going to break it? Yes or no? Or are we going to hard close, create a new 3? Nope, bang, gone.
See? That's contracts closing because it hard closed.
So now you would have the justification to say, hey, I'm in a passive contract. it makes sense to get
Because
rid of this
everybody
thing. It
who
makes
entered
sense
here
to now
wants to
leave
lock in
this trade
profit.
because my passive contract no longer has
This
value.
moment right here,
It has a
it's like if
diminishing
we hard
value. Your
close
passive
this,
contract
you're
now
gonna
has a
see
diminishing value.
people locking in profit.
Hedging a position means that if you're in a long, you turn it into a short. So hedging a position means like this. If you enter a short here, you take that short, you're in profits, you take that short and you exit your short here and also enter long. You're hedging your position. So you're activating two contracts at once. So if you had like a $500 short here, you'd enter a $1,000 long here. You close this 500, which is 500 of this $1,000, and then you buy 500 more. So you would enter like a long for $1,000 right here. That would be hedging a position. So it's just double ending the position, like selling your short to activating into a long. Otherwise, it would just be a $500 position here, and you close a position there for $500, and then you enter, later on in the test. You could also refer to that as hedging when you re-enter later on the hold level, but the traditional meaning of hedging is just closing one contract directly into opening the other. So a $500 short would turn into a $1,000 long contract right here, all in one move. It's not two separate 500. It is, but it's combined into one. It's combined into one. Entering long while you were in the short. You're still in the short. You're entering long from a short, but it closes your short and opens it in a long. Like it's reversing your position. You were shorting and then you wanted to long. One trade here, short, and a short long that live together here.
It was actually a 3-minute candle. I didn't realize that. That's why it hadn't happened. So that 1-minute candle right there opened up this range.
Reverse.
That was actually a 3-minute candle that closed. That's why it happened like that. A little bit of a strong candle. I didn't realize I was on the 3-minute. I thought I was on the 1-minute. Well, that's fine. It's one and the same here. And the closer this thing gets, the more it's going to start, shorts will start closing. That's the way it works. Just like magic, being able to predict the future, right? And it's not. It's just very actually common sense kind of thinking. It's just, you have to deduce the reasoning of why people are making these decisions, right? But, then the smart people know where targets are, right? So this was already tested. So you'd be inside of this range somewhere. So you would have already actually exited off of the base of this range. So you would have exited right here. What if this trend was created in this moment? So if you actually rewound this thing, you'd be right here on one time frame. You break through that and you're going to try to hold this. So yeah, you would have exited somewhere in this range down here. You might not have gotten your perfect exit here, but I could also be missing something. It's this inside of this candle here. So whatever's next on this. Yeah, well, that makes sense. Whatever's next, it's right there. So that's actually exactly what it would be. That's where your target would be. So actually people who were down here, so you would have already actually exited.
Notice how 3-minute level right here is holding the move. It's not hard closing the 3-minute level. That's why the 3 minutes used on this side. Pretty sure that's why I'm zoomed into the 3-minute for most of this trade, because I probably noticed that 3-minute level here being tested, 3-minute level here holding it, 3 minutes, test 3 minutes, hard close 3-minute break move. Off of the base of this range. So you would have exited right here. What if this trend was created in this moment? So if you actually rewound this thing, you'd be right here on one time frame. I would always use limit to lock up profits more, Lewis. I would never use market unless it's an emergency situation. Down here. You might not have gotten your perfect exit here. But market sell is more of a hedge. You can hedge a limit on market, or you can here. So whatever's next on this market limit hedge. But yeah, I would always do limit. Yeah, well, that makes sense. Always limit. You should always have your strategy and your plan first. That's where your target would be. So actually, people who were really good at this thing were already out anyways, because there's just no point to hold past this level right here. There's just no point. Market costs so much money to do market orders. It costs such a higher percentage. Test the greediest point in the next one anyways. Yeah, it's ridiculous. I just walk through the move at this point. So it does move right through the 15-minute. So that's fine. I just walk through the move at this point. I remember the rest of this. It just doesn't make sense because there's too much risk associated with opening any position here, short or long, regardless of what. So we went through a bit of a brain melt today. I gave you guys something in butterfly effect that you've never seen before. I gave part of the reasons that I can't talk about butterfly, like the things that I'm not allowed to talk about because it's just too advanced for a butterfly effect lesson, right? Like it's just literally too advanced. So we definitely went through a pretty crazy lesson today. More theory driven, more of a somber tone today, less excitement, less technically driven, but more of a theory layer where it allows you to see deeper meta information on the charts, which of course is way better than technical anyways, because now you're getting the reasons as to why things happen, which allows you to have a better grasp and a better foresight on exactly what's going on in these charts. So I definitely underappreciated these videos before. Yeah, well, it's not by design, my own design to make it less, and it's not by the fault of you. It's just the way in which, unfortunately, I have to teach things, and there's two parts of being a teacher. Like I can't expect people as a first go about in future of trading and butterfly effect and any of these things to start talking about deep set theory like this and the formulas and the reason why people would just tune out. They already tune out because the material's too tough as it is. Even future of trading for most is too tough, and it's why I have such low subscribers. But then to further push that factor of difficulty would just not make sense. So it's not by anybody's design or fault, but just to the benefit of mentorship is where you can get that deeper understanding, and the value of active and passive contracts cannot be overlooked, because this is you're literally talking about the first parts of chart architecture, passive and active. You're talking about the unseen layer as where something could potentially happen. It's like the unseen variable. It's variable X, right? It's that variable that can control it all. It's the starting point for it all, and it's why it's kind of segmented into chapter 2, because instead of teaching it like this deep set theory, at least I can break up butterfly effect into chapters of understanding where one day at a time becomes, oh, awesome, now I can apply it. That's often why people, if you think about it, that's often why people gravitate towards one day at a time. So many of you actually in here have said one day at a time is your favorite lesson, because it's the simplest part of butterfly effect that actually makes you feel valuable. So it's the simplest part of the entire course that makes you feel like you're not stupid. That's why everybody loves it so much, because it's kind of the lesson that everybody can really resonate with, because it is kind of dumbed down. And again, not by the fault of anybody or the design of the material on purpose. It's designed like this because there's only one way in which it can properly be taught to really put people down a path of the highest amount of success, because it's already abysmal. Learning butterfly effect is already abysmal, and I realized that before I even put it out. It's just like, yeah, I expect people to be able to keep up with this shit. Sure, dude. So it's already kind of like, but hey, that's why mentorship is so good, because we talk about stuff like this. And yeah, this is like critical. You guys won't understand it in one pass about, because it is such deep theory. They work together, use the butterfly effect channel, start talking about actives, passives. It might feel weird. It might feel not unnormal. It might feel odd. It might feel out of place because you're so used to using hold levels and break levels. But this is the layer where of day trading where you call it the cotton factor, call it whatever you want. This is that deeper layer that allows you to dig and find the real information. Not that the hold levels aren't real, but there's always something before a hold level. There's always something before a ladder point. There's always some kind of secret sauce in there. So this is really the beginning of that path for you guys. So heavy in theory today, but also valuable in end game. Most valuable piece you guys have probably gotten so far. Okay, guys, cheers. Thanks for stopping by today, and we'll see you on the stream in, I don't know, like half an hour or something. All right, bye.